small up, about 0.25%. So it's higher. Nifty Bank is up about 1/3%. There is 48,200 plus. Mid-cap index is up 0.15. Small-cap index is up about 0.4% or so. You've got about 35 names higher and about 20-odd stocks, less than 20 stocks, which are lower at this point in time. Too early to look at market breadth, but I mean, stocks are still opening up. But it's a decent start, about 70 points higher, 22,500 nearly, but not quite there. Surabhi.
Okay, let's get down to stocks and not bad, about 80 points higher on the Nifty. IndusInd Bank reacting well to the reassuring statements coming in from the Reserve Bank of India. I mean, RBI basically reminding everybody about the latest capital adequacy ratios and other parameters, saying the bank is in a healthy financial position, 4% up over there. Bajaj Finserv about 1.5%. Tata Motors has some green on it, 1.5% higher. Among the other large caps that are on the green side, L&T about 1%. ICICI Bank is looking good. ITC is up about 0.5%. Reliance is aiding the bulls' cause, at least this morning, so far about 0.5% higher. So these are the early movers on the upside. Let me look at what is down, I mean, if anything, in a meaningful way. BPCL, Britannia, Nestle, these are some of the names on the downside. And the tech names, remember tech was a big drag last week because of this whole concern about if the US growth is faltering, then what happens to BFSI spends. That's still kind of playing through the system because Wipro, HCL Tech, Infosys, TCS, all of them are either flat or slightly negative to start the day. So tech remains a bit of a spot for bother. But otherwise, it's looking good, 80 points higher and holding. The Bank Nifty is actually leading from the front now with a gain of about almost 0.5%.
Even in the broader markets, tech remains to be a bit of a drag right now. We have First Source, which is lower. We have a bunch of other tech names as well, which are lower. But the broader markets are a lot better than what the index would tell you. The index tells you that the mid-cap index is up around 1.5%, but we have 1,400 stocks which have opened in the green, as against 630 which are in the red. The ones which are in the green, we have Muthoot Finance, which is doing extremely well. Obviously, gold financiers benefit from gold prices being at a record high. We have a couple of these other names as well, metal names. NMDC has moved higher, about 2% higher on that counter. Bandhan Bank up about 2%. We have Hoodco, GSPL, Crompton, all of them sitting with gains of about 2 to 2.5%. On the way down, LTI Mindtree, like you pointed out, down 3%. First Source down 3%. We are seeing some weakness in Tube Investments as well, down 3%. And some profit taking on names like Polycab and Jubilant Foodworks. In the cash market stocks, the ones which really stand out on the way down, we have Gensol, continues to fall, ended last week with a big cut and continues to fall this morning as well. Post-close on Thursday, we got the outcome of the board meet where the company has announced fundraising and at the same time they've announced a stock split as well. Street doesn't have any of that. It's down about 5% on that stock once again. Senco Gold continues to fall in this despite gold prices being higher. We'll keep an eye out on that one. Titan has opened higher, whereas we've seen some weakness in Kalyan Jewellers continue.
Just adding one more stock, which is Ola. Remember this whole issue of their registration agency, Rosemerta, saying that they should be taken to bankruptcy court. That stock's down 2.5% right now.
50 rupees, under 50 rupees now on Ola. Well, 80 points higher on the Nifty, 22,480, 490 is where we have what we have on the index right now. So it's becoming a little stronger, but we'll see. Not quite at 22,500 still. And, I think the 20-day moving average is even higher. I think it needs to travel another 100 points upwards before we get to the 20-day, which is the first solid daily moving average, above which I think there'll be more interest which starts to come through. But otherwise, it's a decent looking screen that we have. Lots of 2-3% movers, although volumes are still just about picking up at this point in time. I mean, there's actually volume on the downside as well, so don't lose sight of that. Manappuram, Muthoot is up, Manappuram is down. Mobi Quick, I can spot, is down about 3%. I'm not sure there's any news flow here. There's Phoenix Limited, which is down 1.5%. Greaves Cotton is down 2%. There's, IKS is down 6.5%. IKS essentially is essentially they work with US hospital companies and insurers in the US, essentially to streamline and make their processes more cost efficient. So it's completely, the business is completely in the US. I'm not sure if there is any specific news flow here. But
there was only this article that I read over the weekend, which had nothing to do with business operations, basically highlighting how IKS is now, Mr. Jhunjhunwala's largest holding, above Titan as well. So that really did the rounds over the weekend. But again, that had nothing to do with the business fundamentals. I don't know if there's any selling that's happened, but volumes are only 35,000. I don't think any major selling.
Yeah.
But nothing on the fundamentals.
Yeah, absolutely. It's since the IPO, it's not a phenomenal performer, but of course, I mean, everything is corrected as well in the market fall. So we'll sort of dig deeper and figure out if there's anything which is affecting the sentiment in this one. Ashwini Agarwal is our market master of the day, founder and a partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thank you for your time. I mean, I think, are we at that point where we've already paid for our sins in that sense, the exuberance, excesses, etc., and now it's the turn of the US. So it's not necessary to look at US drawdowns and say, well, maybe it keeps a lid for a while, but we've already been through the damage. What's your sense, Ashwini? Near-term and a medium-term picture.
Yeah. Morning, Prashant, and thanks for having me here. What you say is absolutely right. I think bulk of the damage is done. You will continue to see episodic news flow, which is concerning because the policy environment in the US continues to be extremely fluid. And you'll probably see concerns surrounding the US dollar, which, if it weakens considerably following the policy actions that are ongoing in the US, might create a bit of a cloud for exporters in India. But on a bottom-up basis, now I find a lot of companies that look very interesting on valuation. So I think bulk of the damage is done. Having said this, if you go back to corrections over the last 20 years, they typically tend to be 12 to 18 months long, with bulk of the damage done in the first 6 months. And this might be a repeat of a similar pattern. In the sense that the market peaked in September of 24. We are already 6 months into it. Broad indices are down about 16-17%. A lot of damage in the mid and small cap space. And serious value emerging. So from a short-term perspective, it's very difficult to say. I think, a small rebound is quite likely in the very short term, given the extensive fall that we've had in recent weeks. But I think a bigger or a more durable bottom is still difficult to say because the policy environment continues to be extremely fluid. And please remember that, if the world is slowing down, India will slow down as well. So taking those two things into account, I'm not sure if the durable bottom is another 5% lower or is already behind us. It's very difficult to say. From a medium-term perspective, I think one should be constructive and do some bottom-up idea picking here. That's how I think about it.
We were talking about IKS, and we'll have an alert out there for you. Just coming back to you, Ashwini, there's a lock-in which is ending, as Hormuz has pointed out earlier. So I think this is...
it's a 3-month lock-in. 4.2 million shares open up for trade in the market now.
There you have it.
And this is about 2% of the total outstanding shares. Since IPO, the stock's not done too bad. So I guess it's just people rushing to book some profits. 9% down. So all the locked-in investors perhaps want to cash out today. That could explain it.
10% cut now. And I think there's a very large pipeline of stock. Maybe we'll put that data out. I remember seeing in November, humongous. Big lock-ins because we saw such a big IPO boom all the way till December last year. A lot of these 3-month lock-ins, 6-month lock-ins, then of course, a lot of that. It's not that
there's
all
also
of it.
Vishal Mega Mart. That's actually, I have the list in front of me. Maybe quickly just pull up the stocks. Vishal Mega Mart, the 3-month lock-in is ending today. The Sai Life Sciences, there's One MobiKwik. IGI anyway has been absolutely slammed hard. So these are some of the counters where either a 3-month lock-in or different periodic 1-month lock-ins could be ending today. 1-month lock-in today is ending for Ajax Engineering as well.
I'd be most interested in seeing what happens with EMS Limited, because the entire EMS space has been very much in focus. From the issue price, the stock has moved about 200% as well. But from the post-listing high, it's nearly halved. And we have 18-month lock-in ending on EMS listing, which has outstanding equity of about 20%, 1.1 crore shares. So that's MobiKwik, which is lower. Just EMS Limited is the one we'll keep an eye out on. Currently holding in the green, but remember 20% of its equity comes out of lock-in today. The stock's already corrected about 40% from its high. And from the IPO price, it's up about 200%.
Okay. So anyway, since Ashwini, we're on this subject of paying for our past sins, as Prashant very nicely put it. What about these issues? I mean, this is another risk that you're now running, right? I mean, where, as we're seeing, this is today's theme, wherever lock-ins are ending, people are using the opportunity to quickly get out. What would the advice be in general on some of the recent issues? How did you find the quality of paper that came in? And should one be worried? Does this become another trigger to basically get out of any of the recent listings?
Survi, I think it's not a standard answer because some of the IPOs that came in were very expensive and then they traded up. So valuations became ludicrous. So even if at a 50% decline, I mean, some of the stocks that I've looked at recently to try and find out if there's any value are still trading at 50, 60, 70 times price to earnings multiple. And those are not, palatable to me. So I would say that, yes, the opening up of lock-in, if it creates a fall in the stock price and valuations are reasonable, by all means, go for it. Because, my sense is that there is a lot of panic, I wouldn't say panic, but I think a lot of uncertainty that's driving investors to take very short-term calls, and that is an opportunity for medium-term investing. But I would say that the starting point of valuation has to be reasonable. If the valuations are still in the vicinity of 40, 50, 60 or thereabouts, I would stay away. We can find plenty of things which are now in the 10 to 20 PE range, and I think that's where the value picking should be attempted. So it's not so much as selling should be something to worry about. It should be seen as an opportunity if the valuations are right. That's how I think about it. The quality of the paper you asked, some of the quality of the companies is very good, beyond doubt. But there is a valuation that one has to contend with.
And of course, I mean, if you're trading, then this kind of data point becomes very important, right? I mean, you don't want to buy something and the next day, if you're trading specifically.
Yeah.
So this is, I mean, you've got so much to track. The global stuff, local stuff, this is lock-in business now. But of course, that's the nature of things. I think it's coming up a little bit from the lows. And it's a solid business. I mean, I remember speaking with them here on the day of the listing. But of course, it's all about what you pay at the end of the day. Mangalam, what else?
What else? Just ask Ashwini a little about the consumption space once again. I mean, he didn't seem like he's very interested in anything above 10 to 20 PE because that's where value pickings are. But look at Godrej Consumer. The stock opened in the red, and from there, swiftly it's moved higher. It's moved to the high point of trade. And in consumption itself, we look at rural consumption. One of the key proxies is looking at two-wheelers too. So you have TVS Motors too, which too has recovered from the lows. We are seeing some traction in M&M as well. So that's moved to the high point of trade. We have a few stocks which are recovering from lows. Britannia opened about 3% lower, now just about breaking into the green. Hindustan Lever just about flat, but again, recovering from lows is what we've seen. Ashwini, any proxies that you have in the consumption play, specifically because rural is doing better and urban's expected to do better? Is this an investable theme right now?
Yes, it is. I mean, I think, in the small and mid-cap space, there are plenty of domestic consumption-oriented stocks which are trading at extremely attractive valuations with very solid balance sheets and free cash flow profiles. One has to just look deeper. Unfortunately, I'm not in a position to share names. I think even in the large cap space, the consumption companies which are domestic market oriented will probably give you decent returns of mid-teens or so on the next 2 to 3 year basis. Like you said, I think the outlook for the rural demand is a little bit positive and urban demand is expected to come back as well. And I also think that the exporters will continue to get buffeted by the outlook on the rupee dollar and the outlook on tariffs and the uncertainties arising from there. So, that will cause a shift towards the domestic economy. But the one space that I think we should all pay a lot of attention to are the financials. I mean, financials are really very, very attractively valued. I think many of them are evoking the kind of carnage that we saw in 2018, 2019. I don't know if things are as dire this time around because the starting point of capitalization is much higher. And RBI has been extremely vigilant ever since the Yes Bank, Diwan Housing, ILFS debacle over 2018, 2019. So I would be very surprised if there are a lot more skeletons to tumble out. So I think that's one space which offers a lot of value to me. I think those are the two spaces: consumers and financials that look very interesting to me.
Very quickly, Ashwini, you briefly mentioned exporters, and I know that you have a view on sort of apparel makers, textile apparel makers, right?
Yes.
Again, space is not done very well. Are we waiting for these tariffs or anything? I mean, what's plaguing the space?
I think, again, they have done extremely well over the last 2 years in terms of select stocks, and valuations in some cases might be a little bit stretched. Second is that there is an uncertainty arising from the outlook to the currency as well as what happens to the US demand in response to all the policy action going on there. So, those are the two worries. But I also think that this is a huge opportunity for India. I think apparel making is a strength for India in many ways, and I hope that the ongoing conversations that are going on with the government of India and the US in terms of putting in place some tariff agreements or preferred partner status, some of that comes through, which will put aside the uncertainty these stocks are facing right now. So I think I'd wait to see the outcome of that. But I think longer term, the opportunity is there. And I don't think this is an industry that can go back to the US in terms of manufacturing. It's just too manpower intensive for it to make sense to do it on mainland US.
Okay. All right. Ashwini, thank you very much. Great to get that perspective from you today. Pleasure having you on the show. You have a good day, and we look forward to the next call soon. Well, the market's actually looking very, very good. I mean, we started with about a 70-point opening gap, and now it's expanded to almost 150 points. So the bulls are in control. The mid-cap market's doing even better. Look at the mid-cap index, up about 1%. It's a nice green shade that we've got going on the screen. Well, for the time being, we're putting the spotlight on the real estate space. There's been some concern in various pockets of the market about whether there's going to be any sort of a dip in perhaps demand for, ultra-luxury housing, considering the 5-month-old stock market correction. Well, the next company on our radar is actually from the realty space. We've got Pavitra Shankar, Managing Director at Brigade Enterprises, joining in. Brigade, of course, has been launching lots of premium projects in Bengaluru, in Chennai. So let's get some perspective going. Pavitra, great to have you with us on the show. Thanks for joining in. And I really want to start with that question, just address it head on. First of all, tell us that, what percentage of your revenue classifies as ultra luxury? I mean, I don't know, different developers sort of bucketed differently. For some, it's above 10 CR. For some, it could be above 5 CR. So what is that segment for Brigade? And are you seeing any sort of a slowdown in inquiries, in action in that segment?
Hi, good morning. Thanks for having me. So for Brigade, our portfolio is sort of diversified across mid-segment and upper mid-segment. And definitely now that we're seeing the preference for more premium housing, we have launched a few projects on that account as well. So as far as we are concerned, predominantly 80% of our portfolio is mid and upper mid-segment. And what we deem as premium housing is, I would say, 5 CR plus. So we have one project live in each of our major cities, Brigade Insignia in Bangalore, Brigade Icon in Chennai on Mount Road, and Brigade Gateway Hyderabad in Hyderabad. And all three of them are basically, inventory is above 5 crores. In Bangalore, it's a little bit lower, about 4 crores plus. Chennai goes as far as 7 to 22 crores, and Hyderabad is 5 to 15 crores a unit. And each market has been a little bit different. So Bangalore's been pretty stable. Definitely at launch, things are more active at the time of launch, and then they stabilize. We don't intend to sell out, inventory at the time of launch itself. So we are happy with the pace of sales in Bangalore. In Chennai as well, at the launch time, we sold more than 25% of the inventory, and it is stable. Although I would say Chennai is slightly slower paced than Bangalore when it comes to very premium inventory. And in Icon specifically, it's, much higher than what the Bangalore price ticket size is. And finally, in Hyderabad, we sold more than 200 units at 5 crores to 15 crores all within the span of a couple of weeks. So Hyderabad is a completely different market entirely. So I would say different markets in Bangalore are different, in the country are different, whether you're looking at three southern markets or elsewhere, Mumbai, NCR. I also think it's also, it's also what are the expectations? When it is premium, we don't need to sell right away. We do need to see, stable interest in inquiries, walk-ins, people inquiring about the project, and then the eventual conversion.
But has there been, Pavitra, that's what I'm trying to, what I'm trying to understand from what you say is that Chennai has been, well, not sluggish, but slightly quiet. Hyderabad, things are flying off the shelves. Bangalore seems to be stable. But has there been some sort of a dip in the level of inquiries or footfalls when you launch these projects vis-a-vis, say, 6 months to a year back?
We didn't really have the very premium projects about a year ago. I would say the market was much more frenzied a year ago because the pricing was still, in the movement of going up and up. I think prices have stabilized across the board, whether you're talking about mid-segment or upper mid-segment or even premium. A lot of that has to do with the price discovery itself by developers. I think all of us know and have the right idea in mind when it comes to pricing at launch. I'd say in the last couple of years, for all of us, it was more of a discovery. Okay, let's launch it at this rate, but very quickly you could take up the rate. Now I think we understand where the market has stabilized, and these are very good numbers. The market has already increased 100 to sometimes 150% in some parts of Bangalore, for example. So we don't expect the rates to increase like that, and therefore I think even the urgency from customers to, take the decision on day one, that level of urgency isn't there. And many of them, seeing the ticket size, they do take their time. This is not the ticket size where someone just comes in on a whim and does the purchase. So they do want to understand, they do want to compare what are the other projects available to them. And I think it's still a careful decision-making, which it should be. And because all three of these markets are fairly stable when it comes to, inventory movement and all of that. So it's not speculative in any of these three markets.
You take that point, just hold on to that thought, Pavitra, because there is some update coming in on SpiceJet as well. We all were wondering why is it that Ajay Singh has gone ahead and sold his stake at 45 odd rupees, despite, the company recently raising funds at 61 rupees itself. The company said that they've done that to, fund their Spice Health business. Furthermore, he will go ahead and utilize the company has informed the promoter has informed the company of his intention to dispose up to 3.15 crore shares to fund allotment to Spice Health. And the stock has recovered from the lows because they've also said that they will convert about 13.14 crore warrants into equity shares. So the promoter's stake, which is currently fallen because of this sale, will go up to around 33.5% after conversion of these warrants itself. So the rationale has been given. It is to fund the investment in Spice Healthcare, and the promoters increasing their stake is something that the streets taken note of. The stock, which was at around 45 flattish, has recovered a wee bit from the low. So we'll keep an eye out on SpiceJet itself. But let's get back to our conversation with Brigade Enterprises. Pavitra, you had targeted about 63 to 6,500 crores worth sales in FY 24-25. With these launches that have come by, have you made any early projections for FY 26 in terms of launches, collections, and sales?
Do you mean FY 25 or?
FY 26.
FY 26. So in the coming year, we will look to increase whatever we've done in this year. I mean, we're fortunate to have received some approvals in the month of March itself. So we're looking to finish out the current year, FY 25, on a strong note, and we're yet to see where those numbers will come up. But that said, all of our launches in the pipeline for FY 26 are still looking good. Approvals seem to be stabilizing, but taking more time than we generally expect. In the coming year, we will have more launches in Hyderabad and Chennai. Those are our new markets of focus, and of course in Bangalore. So we don't really give guidance, but we're hoping to continue to increasing our numbers at the 15% to 20%, depending on the year over year in terms of value.
Pavitra, hi, good morning. Prashant here. So just to take that point forward, I think the planned supply since the start of financial year FY25 was about 12.6 million square feet. How much have you launched so far out of this?
We have, while, at the end of the Q3, we had released some numbers, but since then we've added another 4 million square feet of launch. So thus far, it's almost touching 11 million. So while we had indicated launching about 12.5 in residential, we've touched 11 million, and I'm quite happy with that. Hoping to maybe get a couple more before the year ends. But, the idea is that we'll be selling this over the course of the next couple of years. So while the timing is always, trying to get it within certain quarters, what is happening on ground is still pretty stable. So it's really a question of whether it comes into Q4 or goes into Q1 next year.
Would I be correct in saying, Pavitra, that, of course, nobody wants approvals to be delayed, but the point is delayed approvals were a problem about a year back. I mean, when things were flying off the shelf, right? I mean, very fast. But maybe not so much of a problem. Maybe things will pick up. As you said, you already have some approvals in the month of March. So is that a fair way to look at things? And could you share the planned launch pipeline for 26, or is that too early?
Yeah, it's a little early for what we would want to do in FY26. I think we still need some clarity on, where this year is going to end out before I can give any kind of indication how next year is going to look, because it is a percentage increase over what we're able to do this financial year. But what I'm trying to say is that things on ground are healthy. I know there are, more comments being made in terms of how is the real estate market doing, but I still feel it's very healthy. And sometimes it is skewed by what we saw over the last couple of years, which was, every single factor that could go well was going well. And the only thing that was being a challenge was just getting the launch out on time. But what's happening on ground is still that you're still getting many walk-ins coming into site. There's a lot of excitement when a project launches. There's much more understanding in terms of what price we should launch at. So in general, I think it's a very stable and still a very good time for developers, and also a good time for people to buy, because we continue to see prices increasing at a normal rate of, say, 8 to 10%, as opposed to what it was, 30% year over year. So I still think it's a good time for people to buy.
So it's a stable market, and that's perhaps good for customers, and then therefore good for realtors as well. Very quickly, Pavitra, I want to ask you about the other big headline from last week for the sector. I mean, a giant like Blackstone taking such interest in the residential market, right? They've always been huge in commercial, but with this buyout of Kolte Patil, what thoughts in terms of valuation for real estate companies now, and for Brigade's own plans? I mean, given this kind of large institutional interest, are you, would you be thinking of raising any further equity capital in the near future?
So we actually did a QIP in August of last year, and we've raised enough funds, and we also have enough funds being generated by our internal accruals itself to fund our land acquisition and business development. So we are quite happy with our equity position today. In terms of other real estate companies, I think everyone's just doing what they need to do in order to be ready to do more land acquisition business development. Someone like Blackstone entering the space, I think, is great. It just adds more formalization to the entire sector. Good luck to them, and good luck to the residential sector. The more quality players, the better.
All right. Pavitra, we'll leave it there. Thank you very much for joining us. Good speaking with you, and look forward to our next one. Well, I think the market's holding up very well. 150 odd points in the green, 22,550. And maybe now, of course, is a decent time to look at the overall market breadth. So 2:1, comfortably, 1,650 stocks are higher, and you got about 850, 870 stocks which are lower on my screen. So this is a fairly decent screen to look at. We'll take a quick commercial break here. There were some flashes, by the way, with regards to Trump and Putin, a call. I mean, so we knew that they were supposed to speak this week. Time, date, etc. were unconfirmed, but now we know. And I think these were comments coming in from President Trump himself saying that that call is going to happen tomorrow. And with regards to Russia and Ukraine, he'd be in a position to announce or essentially talk about, resolution in some way. So that is also at the margin important for the market because those hopes of that happening quickly had diminished into the end of last week. We'll take a quick commercial break here. We connect with the management of Patanjali Foods and discuss the quarter gone by, the outlook going forward. Stay tuned.
Broader markets are doing a lot better. We have transformers and rectifiers, which is up 6%. They won an order worth nearly 700 crores. KEC International, Vivek told us this morning, a 1,200 crore order. That stock continues to do well as well. And we have a bunch of other, infra names, TD Power, etc., which are spiking as we speak as well. But Patanjali Foods, that's the stock on our radar. Jefferies has turned bullish on the stock. In fact, they've initiated coverage on the stock with a buy rating. Target price upwards of 2050 is what their target price is. They expect near double-digit top-line growth coming in for the company, along with margin expansion as well. So to discuss this and talk about the growth outlook, we have Sanjeev Asthana, who's the CEO at Patanjali Foods, joins in now. Thanks a lot, Mr. Asthana, for joining in. Before we get to this business, I just want you to, for our viewers, set the record straight on the insurance foray that has come in from Patanjali Ayurved and has nothing to do with Patanjali Foods. Please, you do it yourself.
So that's absolutely right. It's got nothing to do with Patanjali Foods, the parent company. That's what's there in the marketplace. They are working on it, and we'll see. Of course, it is subject to all the regulatory approvals, etc. But Patanjali Foods per se, either in terms of involvement or otherwise, will have nothing to do with that business.
And no financial liability whatsoever either, right?
None at all.
Perfect. Thank you for setting that record straight. Let's get to business now. The last time you joined us, you did say that oil prices have been volatile. From the highs, we've seen a bit of a decline in edible oil prices, etc. as well. So far, how has business been? How has consumer sentiment improved over the last month? What kind of volume growth can we expect along with margins in your oil business in the fourth quarter?
So two sort of set of events are driving the change on the edible oil side right now. One, that we are clearly witnessing some bit of slowdown in the imports. In terms of volume terms, that is more than made up by the oil inflation that we witnessed. But broadly, for the year, we are pretty confident of still meeting between 2 and 4% of growth target on the edible oil volume. Pretty confident about exceeding 4% plus of EBITDA margin on the edible oil side. On the FMCG regular businesses of foods and non-food, there is some slowdown we see in the urban area, so that continues. But broadly, we are pretty much within the ballpark range of 8 to 10% target that we are on the food side. The HPC business is still integrating. The first full quarter we'll see in this last fourth quarter now. And pretty much we are on course to achieve 15% growth on the HPC side next year.
Right. So, let's revisit some of those numbers. You said that 4% EBITDA margins in the edible oil business will, maintain. Is that on the cards? And 8 to 10% in FMCG food segment. Will that happen in the fourth quarter, or that's a more medium-term sort of target?
That's pretty much for the annual, business itself. So pretty much on course to both the numbers. And, there's nothing that I foresee now in the balance part of the March for anything to come in which can dramatically change that. There might be minor changes here or there, but pretty much on cards that we should achieve both the numbers.
HPC business, you had earlier targeted about 900 to 1,000 crores in FY25. Will you meet that? And 3,000 to 3,200 crores in FY26?
So that's pretty much on the cards, as I mentioned. So we feel pretty confident about 15% growth rate next year. So that should pretty much take us to the numbers that you mentioned. And this 15% CAGR allows us a lot more, headroom for expansion that I clearly see in non-oral category as well. So oral is a fairly dominant part of a category. We're expecting that pretty much in the home care, personal care, and hair care, also for that expansion to happen now, under the fold of Patanjali Foods now. So next quarter onwards, which is first quarter of next fiscal, we're pretty confident that we should start getting back on stream and build up that 15% growth momentum in the business.
Just a couple of more questions before we let you go, sir. One is on the oil palm plantation. The street believes that this could actually be 20% of your revenues and a decent contribution to your EBITDA as well. When does that happen, and what are your near and medium-term targets here?
So it's happening, every year. Every year, our EBITDA run rate, what used to be about 160, 170 crores, we are upwards of, somewhere around 220 crores odd we make as an EBITDA. So every year that is spiking up. But the big growth in the EBITDA and the contribution to the revenue shall happen maybe in 3 years' time, when all the plantation that momentum that we have of last 2 years, I think will start to fruit. So pretty much from 28, 29 onwards, you will see a big expansion. And that the estimation is broadly that, if the run rate of our targeted sort of plantation size, the margin expansion that we expect to happen, so we should pretty much be nearly 3 times of where we are today in 4 years' time, and pretty much 5 times of where we are today in 8 years' time.
Right, and final question. This is with regards to some of the regulations and macros in general. We heard the Prime Minister speak about, people wanting to reduce, or him wanting people to reduce their intake of oil, etc. Would that be a macro risk to the underlying growth that we're seeing in the oil business? And there were some run-ins that came in from the FSSAI as well. This was specifically on your red chili powder business. So these two continue to remain a bit of risk or the overhang on demand growth itself, right? For oil, if the underlying business itself is not likely to grow as fast because people are staying away from that, could that pose as a risk? And secondly, the risk of regulations, that people move away a little from packaged foods in general.
So I'll address both the questions. So one is what Prime Minister exhorting people to reduce their consumption of edible oil. That is, of course, I think from a health perspective or otherwise, I don't think there's any fundamental shift in reducing the demand per se. And I don't believe that is going to have a big impact on the per capita consumption. We are significantly lower than the evolved markets of the West, and even our Asian peers also. So there's a lot of headroom for growth, and I don't believe that anytime soon that any substantial reduction, voluntarily or otherwise, will happen on the edible oil consumption. And on the red chili powder, we have already issued the clarification. It was a very small sort of lot of which had a problem. Most of it, we have recalled already. And that was pretty much led by, certain challenges which Indian spices had in Singapore and Hong Kong earlier. And so it was part of that process. So we withdrawn. It was very, very small lot and part of a much larger business portfolio. So those are things behind us. And I think, once in a while, this may happen. But pretty much we're working in terms of removing this completely so that quality should not be an issue on any product that Patanjali brings to the marketplace.
All right, we leave it there. Thank you very much for taking out the time, speaking with us here at CNBC-TV18, and speak to you again soon, sir. Good luck. There is Patanjali in focus. Well, look at Ola. Stock's down 5%, and it's got decent-sized volumes as well. Actually, volumes are very large on Ola on the downside. Across on the NSE, 5th largest volume loser. So it's going down and is getting sold with large volumes as well. IKS is still down 8%. LTI, Mindtree, of course, that news out of Citi, 4.5% lower. MobiKwik is down 10%, 11% now on MobiKwik. So fair bit on the downside, even though the broader market still remains pretty healthy. 150 on the Nifty and 2:1 broader market advance decline ratio. Tata Technologies is the next company we are focused on. We have Warren Harris, Managing Director and CEO at Tata Technologies, joining us now to talk to us about business and how things are looking. Mr. Harris, thank you very much for joining us as always. Prashant this side. I mean, you derive a fair portion of your revenues from the auto space. And of course, the sector has been reeling with significant uncertainty due to tariffs. There is slowdown due to competition and EV incentives, etc., being rolled back as well. Could you tell us how are your clients behaving amidst all this uncertainty? Are they holding back in handing out new projects, etc.?
Well, I think it's been a choppy environment over the last 12 months. Certainly here in the US, the extreme policy positions that the Republicans and the Democrats were taking made for very difficult investment environment for our customers. The lack of clarity up until November, I think, was very distracting for many of not just the OEMs but also the tier ones in Europe. You cited the runoff of incentives. We've also got the threat from China. So it's been a difficult 12 months, and yet I think at the beginning of this year, despite the tariff kind of overhang and the lack of clear policy clarity here in the United States, I think the environment is starting now to present an investment platform against which, again, we're starting to see the green shoots of improvement. So, whilst it's been a difficult last 12 months, we are hoping that that the improvement that we've seen January, February, and March will continue through this calendar year.
Got that point. Mr. Harris, let's talk about the automotive segment in particular, which it was, of course, subdued in the third quarter. Is there any improvement so far in Q4, and what's the outlook for FY26?
We're seeing momentum build, and so we are expecting to finish the fiscal year well, and we are seeing the opportunity for momentum to build in the new fiscal year. We are relatively bullish for not just automotive, but for aerospace and industrial heavy machinery. The growth rates of the addressable space that we are focused upon are double digit, and we expect to intersect with that. And we are hoping that as we move into next year, many of the sort of headwinds and the distractions that we've had to grapple with will be mitigated, and we'll get back to where we were in FY23 and FY24.
Well, the highlight has been the double-digit growth that you are targeting in your addressable market. This across three segments: auto, aero, and industrial machinery. And add to that, the question is, this double-digit growth in TAM, does it translate to double-digit revenue growth as well? Will that be higher than that?
Well, when I refer to the 10-12%, I'm referring to auto, aerospace, and industrial heavy machinery. The addressable space for us is just over $200 billion, and that space. So those are the verticals that we are targeting. Those are the verticals that we are focused upon. That space is expected to grow somewhere in the region of 10-12%. That's what Zinnov have confirmed. That's what other industry watch organizations are asserting. So we think that collectively that will provide the type of tailwinds that will support our return to not only growth but double-digit growth as we move into the new fiscal year.
All right, Warren. So double-digit growth as you move into the next financial year. Is it possible for you to break that up into aerospace, industrials, and automotive?
Well, we're expecting, because we're coming off such a, you cited the percentage split of our business. Industrial heavy machinery and aerospace is a much smaller part of our business than automotive, and so we expect percentage growth in those areas to be much higher than what we're seeing in automotive. But we are expecting momentum and growth to sustain across the three verticals that we are targeting, and we are, our confidence is reinforced not just but through the research that's come from the industry watch organizations, but we're seeing it from our customers as well. We're seeing the order book starting to grow. We're starting to see decisions made, and that's informing the type of confidence that underpins the numbers that I've just shared with you.
All right, so growth momentum seems to be coming back. So then let's talk about margins as well. You're at about 18 to 18.5% right now. The company has stated in the past the goal is 20% margins. Do you think that you'll be able to get to those targets maybe next year?
I think in terms of margins, you're absolutely right that our aspirations, our North Star as far as margins are concerned is over 20%. We expect to make improvements to margins next year as the business scales, but I think it's likely to take several years before we get to the 20% mark.
There is so much tariff uncertainty, and you believe that it's not going to be a drag on your growth in this year. I mean, what is it that makes you confident?
Well, I anticipate that the lack of clarity that we've got as far as tariffs are concerned will resolve itself in the next month to 6 weeks. I think that there is clear direction in terms of where the current administration in the United States wants to go, and I think as they're implementing the changes that they have made clear that they want to make, whether we like the tariffs or not, it'll at least provide clarity in terms of the market conditions. And I think it's clarity that's more important than whether we have tariffs or not. I think if the tariffs present themselves as is being suggested, then the market will adjust and investments will be made. And so I think the current uncertainty is likely to be short term, and I think medium to long term we'll know exactly where we stand.
Absolutely. The world waits for more clarity on that issue of tariffs. Thank you very much, Mr. Harris, for joining in and giving us a sense of the business. We do have to take a very quick break now. On the other side, back with the markets, and we'll get Mitesh to give us some more trading ideas.
Okay, welcome back. We've got the market, which is at about 22,535, 140 points in the green. A little bit of drop-off coming through in the last couple of minutes or so. I've been sort of highlighting a few things on the downside. Maybe just look at a few things on the upside. KEC was not there in the mix in the morning, but it's the biggest volume-led gainer on the NSE now. 6%, 6.5%, and huge volumes coming through on this one. Muthoot Finance is another one. Muthoot Finance, of course, I mean, the news was that they've crossed 1 lakh crores in gold AUM, gold loan AUM. There's a 5% pop. And of course, I mean, it doesn't look like, this rapid rally in gold prices has impacted disbursements at all. LG Equipment, I mean, we don't talk about this name very often, but it's the third largest volume mover That's LG Equipment. That's 7.5% on the NSE. That's a big one. And look at something like a MCX. Actually, two exchanges. One is MCX, 4.5% pop, and that's about 5,025. And IEX is up 4% as well. So yeah, there's exchanges, but there's also, Hitachi, which is up 4.5%. Stocks back above 12,500. So that is again, big volumes for a large name in terms of value of the stock at this point. So there's a fair bit happening on the upside at this point in time. When I can sort of name more names, and we'll do that as we go along. Mitesh is with us for now with what he'd like to do now with this gap up, and of course what we've had over the last 45 minutes or so. Mitesh, your sense of things, whether this will last, whether we'll be able to build on this, and your trades.
Yeah. Prashant, I think, but to me, it looks like that we might actually be able to slightly build on this for the simple reason that, HDFC Bank, which is both a part of the Bank Nifty and the Nifty, is turning positive. We had a buy on ICICI Bank earlier in the day, in the morning call. So I think both these stocks are looking good, and that could lend some strength to the Bank Nifty as well as the Nifty. So I think I'll take the chance that we might, actually hit 22,600, 650 zone, which is about 50, 60 points away from here. And with that kind of view, the stocks that I would recommend as a buy on Woodco, with a stop at about 181 and a target of 195 to begin with. Though I suspect we might eventually look at a slightly higher target, but yeah, 195 should be the first target over here. And the second stock, which is on my radar, that's a buy on Indigo Airlines, or Interglobe Aviation Indigo Airlines. That's the one. And this I would recommend buying with a stop below levels of 47.10 for targets of 48.50.
Take that point, Mitesh. Thank you so much for joining in. HDFC Bank doing well, giving it company on the way up. Our ICICI Bank and Kotak Bank as well. Infosys, in fact, too, has picked up. But a lot of stocks on our radar on the downside. Hormaz joins in with the stocks where lock-ins are ending today. Hormaz, a lot of stocks.
Indeed, 7 of them to be very precise, and 19.5 crore shares become eligible to trade as the shareholder lock-ins ending today. But it needs to be specified that, of course, not all of these shares will be sold in the open market. Of course, they only become eligible to trade. And a lion's share of these 19.5 crore shares belong to Vishal Megamart, with almost 15.5 crore shares becoming eligible to trade. 3-month lock-in ending today, 3% of outstanding. Not a significant movement on the stock though, but the one that is seeing significant movement is MobiKwik, and that is where around 6% of the outstanding has become eligible to trade today. 46 lakh shares are becoming freeing up for trade. The stock now below its IPO price. Ajax Engineering is the other one, 30 lakh shares, 3% outstanding, freeing up for trade, and the stock is also below its IPO price. IKS is the other one that is seeing sharp cuts in today's session. 42 lakh shares, or 2% of the outstanding, becoming eligible to trade in today's trading session, and the stock too is down almost 25% from its IPO price. This is before today's fall. Now, Sai Life Sciences is the other one, 4% outstanding, freeing up for trade, 83 lakh shares to be precise, and that too is on the radar today. EMS is the only one that is still having some significant gains from its IPO price despite the correction that it has seen from the top. 1 crore shares, or almost 20% of the outstanding, freeing up for trade. And lastly, Ratnavir Precision, here too 20% of the outstanding becoming eligible to trade, or almost 1 crore shares. So 7 companies, some of them seeing really sharp cuts in today's session.
All right, Hormuz, thank you very much for that. That's IKS, the big one, of course, but there are many other names, as Hormuz highlighted, which are reacting to these lock-ins ending. And it's a fragile kind of trading environment, and it's showing up in a big way, outsized way, for these individual single names. Time for a quick commercial break here. On the other side, our segment, Market Masters. Lata will be in conversation with Ashish Gupta of Axis AMC, and they discuss bond markets, whether things are getting a little robust on the bond side. And of course, what's the outlook for the banking space as well? The big story last week was IndusInd, but they'll talk IndusInd and more coming up in just a bit.
Welcome to Market Masters. Even as Indian equity indices are trying to find their feet, Indian bonds have been having the makings of a rally. Inflation, that is CPI inflation, has been coming below expectation for 2 months in a row, Jan and Feb. In fact, February CPI was below the MPC target of 4%. It came in at 3.61. US inflation too came in below expectations for February. The numbers came last week. And then the Reserve Bank has been taking consistent and seminal steps to boost liquidity. How are fixed income markets placed from here on? And more importantly, what may be the impact of this falling cost of capital on banks, NBFCs and corporates in general? For all these questions, I have with me the CIO of Axis Mutual Fund, Ashish Gupta. Ashish is also one of the best experts we have on financial companies in the country, on F&O volumes, all things market. So, Ashish, thank you very much for sparing time for us this morning. Well, for starters, what's your sense about the Reserve Bank rate cut itself? Now people are running away with expectations of even a stance change and maybe double cuts in April. Your take?
So I think given how inflation has softened, and particularly food inflation, which had been a sticky concern for multiple months, I think consensus is quite clearly betting on a rate cut in April, and in fact, potentially 2 rate cuts coming in during the course of the year. So I think that is certainly on the card. But I think what is most encouraging is the fact that the central bank has been very decisive in terms of really addressing the liquidity situation. And I think you also in your show have highlighted over the past few months how challenging both the core liquidity and the banking liquidity was. And I think these steps that central bank has taken over the past couple of months have decisively addressed it. So if I aggregate all their actions on liquidity in terms of VRR, in terms of OMO purchases, in terms of forex swaps, there has been nearly 6 trillion rupees, or actually a little more than that, that's been really provided as support. Okay. So I think that is, for me, the most important really action by the central bank. Rate cuts and the stance change, of course, has come in more recently, particularly post the inflation print.
Okay, so would you therefore say that we are anywhere close to passing on the deposit cuts, considering that the liquidity is seminal? When do you expect the first deposit rate cut from banks?
So I think not before May or June. I think banks are kind of still struggling to kind of raise deposits. Banking liquidity, as you know, has not turned positive. It's expected to turn positive by April, May only, while the core liquidity has turned positive after this step. The banking liquidity deficit, which was more than 3 trillion rupees, has moderated. It's now less than 2 trillion rupees, but it is still not gone in surplus. Most banks, as you know, have a fairly high loan deposit ratio, particularly viewed from the central bank's lens. And they have actually had to pull back some bit on credit growth. So I think banks are still trying their best to step up deposit growth. And I don't think in the coming weeks, deposit rate cuts are expected. I think deposit rate cuts will be preceded by banking liquidity turning into surplus.
Okay. So immediately, banks for the next 2 quarters are in danger of margins getting reduced. Would you say the rate cut beneficiary is more NBFCs then?
Yes. So I think certainly rate cut beneficiaries will be NBFCs. As you know, the repo rates repo rate cuts typically negatively impact bank margins now because large part between 40-45% of their loan book is indexed to the repo rate. So in fact, we will see the January rate cut itself leading to from 1st April step down in loan yields for banks, particularly on mortgage loans. So that will impact them. But I think more important is what happens on their credit growth. So even if the margins comes down, but if banks are able to step up credit growth, because of better deposits and because of better liquidity, I think that's positive for banks.
Okay. What's your sense about the FII flows itself? Bond has been positive, right, through March and Feb. Yes. And the equity flows, the negativity is thinning. Would you take a bet that we are bottoming out in terms of FII outflows?
So I think we see really a couple of indicators as really providing some lead signals to flows. One of them is really how the global bond yields are trending, and secondly, what's happening to the dollar index, right? And if you recall, the dollar index had moved up really after the Trump presidency to nearly 110, and over the past couple of months, it's pulled back to around 103, and actually it's now back down to the level that was there in October. Yes. So I think that is a really positive signal in terms of the direction of FI flows. If I look at US 10-year yields, which in September was around 3.8, they had shot up to nearly 4.75. They have since then pulled back by about 45-50 basis points. And that's also trending positively. But here, I think we don't have really a very strong signal that they will continue to soften. Okay. So I think for FII flows to decisively turn positive, we need global bond yields to soften further. What is happening as well is that in addition to US, now we are seeing bond yields, particularly long bond yields, having moved up in most markets. Right? Yes. So since September, October, if you see, while Indian government bond yields are actually softer by about 10-15 basis points, US yields are up about 50 basis points. UK is up about 35 basis points. Germany is up 30 basis points. Japan is up 20 basis points. In
short point, you are saying that you are very confident that FPI flows are necessarily going to favor us and EMs just yet.
Yeah.
Okay. Well, actually, when I was talking about banks, there was another important question I should have asked you. IndusInd Bank, are your worries behind you? It is in the price. And would you say that this is only an IndusInd problem? Similar mistakes will not be in other banks?
Lata, I'll refrain from talking about specific stocks. But I think... more broadly, I will just say that banks in India are very, very closely regulated, right? And I think banks in India, in terms of their balance sheet health, whether in terms of capital levels, in terms of liquidity levels, they are very comfortable by all global standards as well as historic Indian standards. So I think that is something we should be confident about. I will not want to give a view on a particular stock or entity.
No, I know you all are constrained to give stock-specific views. Mine was more a problem-specific question. It appears that the ALM unit of the bank was a client to the trading unit of the bank. Many banks keep the two separate. And don't allow you to hedge internally. So that's why the worry is, are many banks doing it, and therefore should we see other banks reporting problems? You don't have such worries.
No. And again, I think it's been reported that RBI is now conducting thematic audit across banks on this aspect. So I think we will have those answers in a few days or weeks.
Okay. Well, I asked you about whether FII flows have bottomed out, or rather their outflows have bottomed out. What's your view of Indian equities itself? I mean, we have shown some kind of resilience around that 21,800 or 22,000 mark. Do you think most of our supposed slowdown, our reported slowdown in second quarter and third are now priced in? Are we at a reasonable bottom?
Yeah. So I think if you look at the economy itself, we saw December quarter GDP print was better than the September quarter. Whether we believe the government forecast for the March quarter or not, but certainly March quarter GDP will be better than December quarter as well. So I think the fact that the fiscal spending came back and capex spending from the government stepped up very meaningfully over the last 2 months, the fact that liquidity tap has been opened up, and also importantly, even on the regulatory front, many constraints on specific entities on lending, some of the caps on CD ratios, lending to NBFCs being eased, migration to new LCR norms being delayed. All those are actually positive in terms of really helping a monetary stimulus to the economy. So I think given that, I believe the economy has bottomed out. Of course, I think we are in a much more uncertain global policy environment. And we need to see really the impact of that, particularly on the investment side. So I think there are those headwinds. The outlook on global growth has also moderated over the past 6 months. You would have seen U.S. growth estimates being pulled down by many economists. So I think those challenges do persist. We have to be watchful what happens on tariffs and therefore potentially on margins for some of the companies. But I think the broader headwinds, which were on the fiscal impulse, the credit impulse, the regulatory impulse, all those have turned.
Fair point. So domestic impulses have at least turned the corner, but we are still vulnerable to global impulses. Therefore, at Axis Mutual Fund, what would be the sectors you all would be bullish on?
So it's actually a lot more company specific across sectors. We are still constructive on investment theme, capex theme. We like the automobile sector. We like financial, as we discussed. NBFC is where we are overweight. Select consumption names because there has been a meaningful correction there as well. And at least we are seeing some signs of pickup in broader consumption. So while urban consumption has slowed over the past couple of months, the broader mass consumption again seems to have kind of found a flow.
Thank you very much, Ashish Gupta, for joining us with your take on all markets, equities, bonds, and of course, in particular, how finance companies are panning out. That's it on this edition of Market Masters and Bazaar. After a break, it will be time for Chartbusters.